Welcome back. This is Jacob Milliken, owner of 9M Investments. And today we're going to be talking about the difference between investing skill and exposure. So we're going to look through understanding alpha, beta, and the real sources of investment return. So starting with some of the basic definitions of alpha and beta. What are those? So beta is the return you get for participating in a market or an asset class. So think S&P 500 index fund, a total market ETF, a bond portfolio, even a basket of like technology stocks. The earnings of form of beta. Beta is not a skill, it's just a compensation taking risk. Over long periods of time, equity markets have rewarded us for accepting volatility, recessions, bear markets, periods of significant downturns. But the beta, we're not doing anything special. We're just buying that index, that fund, whatever it may be. Now, why outperformance alone doesn't prove skill? So he's like, hey, I am in the S&P 500. I'm beating the S&P 500. I'm beating just that beta. Well, how are you doing it? Are you concentrating in a certain sector, or do you have leverage? Do you have smaller companies, or are you just simply taking more risk than your benchmark? And so, for example, of concentration, think of the Magnificent Seven that everybody has rode to the top over the last few years. If you were heavily concentrated in that, you outperformed the S&P 500, and it looks like you're masterfully skillful and out competed, but really you were just over concentrated in an area that did pretty well over the last few years. Concentration can kind of work both ways. If you happen to be concentrated in an area that didn't do well, obviously that's going to underperform your benchmark. So what is alpha? Alpha is the excess return generated beyond what would reasonably be expected from the risk being taken. So true alpha is once you strip away the general market exposure, sector tilts, factor exposure, any leverage, then what have you outperformed your benchmark? And again, if that benchmark happens to be S&P 500 or some mix of something else, you take all those things away. How did you actually perform? So again, alpha is very hard to do especially over long market cycles, that you're going to beat the S&P 500 every single year, or again, whatever your benchmark may be. It's a very hard thing to do to consistently beat that benchmark typically. Again, once you strip away concentrations and things like that, it really kind of shows that, that beta is definitely you want to have a piece of that within your portfolios. So a couple of examples of how this has worked in real time. Obviously, Buffett is one of the most famous investors of all time. Um, but when you look at his portfolios, they've done pretty well because they've been pretty concentrated over time. Coca-Cola for a long time was an enormous percentage. Apple grew into over 40% of the fund at one point. They've since then started selling off over the last few years. But what I'm getting at is the concentration within this portfolio is, again, when we talk about how did they outperform, well, in his case, a lot of that was concentration in the right names. So, when you think about Buffett's returns, they weren't not just stock picking, they're investing in quality business. He's always had a value oriented approach where, again, he's looking for companies that show value that he can increase. Typically, lower volatile companies have been a big piece of his pie. But again, it wasn't just picking. But once he decided to pick, it was the knowledge and the concentration of some of those picks that really drove the outperformance. Contrafund, Will Danoff, who ran the Contrafund over at Fidelity for a very long time, just retired over this last year. And when you look at Will Danoff, he beat the SP 500 roughly about 2.9% over his tenure, again, over a decade. So a good example of somebody that year over year beat that benchmark. And interestingly, Danoff has discussed talking to Buffett and really standing up the idea that when you have conviction in an idea, really get behind it. And so Contrafund was highly successful, but a lot of the reason why it was outperformed is in the names that they had conviction in, they concentrated the exposures and they outperformed because of that. So when you think about, is it skill or is it just market exposure? It's a little bit of both those things. But for the example of Will Danoff and Buffett, they both, when they had convictions and names, they took the risk and over concentrated in those areas. Now, they happen to be more right than wrong over time, so that outperformed. So again, when you start thinking about investing skill versus market exposure, over the long run, market exposure is the more important of the two. Investing skill hopefully can give you some upside around the edges, but being in the market is going to be the biggest part of did you win? And the kind of the old adage is time in the market versus market timing is the most important thing. So the more time you can be exposed to the markets, and again, fully knowing the risk of ups and downs and volatility and things like that, but that exposure is typically rewarded over the long term. Now, again, can you add some investing skills? Are there things to help, protect from downsides and things like that? For sure. So, but that being in the market and being exposed to those things and having a diversified portfolio, so you kind of take advantage of all the different things, is really the bigger part of that skill. And so, I hope this was helpful. If you have any questions on anything that we discussed today, feel free to reach out. I hope you have a great day.